Good. So you're enjoying the free session courtesy of RCM Online College. And of course, the charges are provided below. So you can be able to follow this immediately after we are done with the class so that you officially join the classes as you prepare for your April exam. So what you want to handle today, is marginal and absorption costing concept. You are required to come up with marginal costing income statement, absorption costing income statement. And of course, given that we are using the same data to prepare the statement under two different methods, it means number 3, you are supposed to prepare what we call a reconciliation statement, right? So how do we come up with a reconciliation statement? That's what we want to do here. And of course, if time will allow us, we'll be able to prepare a reconciliation statement of the same to reconcile our profit as per marginal and also profit as per absorption costing. So let's read. The following information relates to the unit manufacturing costs of product TM made by Timua Limited. So you have the selling price less variable production cost, variable selling cost, then we have our contribution. To that, we have additional expenses. Number 1, the budgeted fixed production cost is 4,200,000 per annum for a normal production of 14 or 140,000 units. The budgeted fixed costs are incurred evenly during the year. There are 2 periods in a year, each of 6 months. During the last financial year, the following results were achieved. So number 1, we have period 1, period 2, which means the production is not per month, but it is for every 6 months, right? So for period 1, we are talking about 6 months. Period 2, we are talking about 6 months. We have production in units, we have sales in units. So you can see what was produced is not equal to what was sold. So it means we are expecting some closing stock here. Then if you look at period 2, what was sold is more than what was produced. Then it automatically tells you there's some element of opening stock. If you sell more than what you've produced, then of course you actually have some opening. Stock. Great. So let's see what you're going to do. The difference between marginal cost and absorption costing is basically the manner in which we are going to treat the fixed production overheads. So marginal cost and full or absorption cost. Absorption cost, right? Good. So what we have here, under marginal cost, we have what we call variable production cost. It's just variable production cost, which is normally direct material, direct labor, right? Plus variable production overhead. But now you can see the only variable production cost, the total, they have combined all of them, both variable direct production cost and of course, variable production overheads. All of them have been combined together to give us 120. How about absorption costing? So absorption costing is a combination of what we call variable production cost, and also fixed production overheads. The fixed production overheads from the word absorption are normally absorbed into the production process using absorption rate, right? So what do we have? We need to bring in now the fixed production overheads. Fixed production overheads. Great. So can we get the fixed production overhead? Remember, production is done on after every 6 months. And we are told under information number 3 that the budgeted fixed costs are incurred evenly during the year. So what do we need to do? We need to take the total budgeted fixed production cost for the entire year. We divide by the number of units. So that we get the fixed production cost per unit. That's number one, right? Because the fixed production overheads are absorbed based on the units produced. So when you take 4,200,000 divided by 140,000, what are you getting as the fixed production overhead per unit? What are you getting as the fixed production overhead per unit? You take 4,200,000, you divide by 140,000. Divide by 140,000. What are you getting as the fixed production cost per unit? Yes, what are you getting? Good. So we are getting 30. We are getting 30. Good. So that will give us total absorption cost because it is only fixed production overheads that is forming part of the product cost. All right. Then, of course, for this one here, we have 120. So once you have the marginal cost, and full cost, then automatically you can come up with the income statement. So number one, we'll start with the income statement. Income statement under marginal costing method. Good. What we need to understand is, irrespective of the method you are going to apply, the revenue figure will not change because revenue is about units that have been sold multiplied by the selling price. So our revenue will not be affected in any way. What will affect, or what will be affected by the method, is the cost of sales. Why? Because this now depends on the units of output or units that have been produced. And remember, we have production cost. So that's where the problem, or that's where the difference comes in. So let's start with the sales figure. Let's start with the sales figure. We are told that these sales were made. We are told that these sales were made in what pattern? We are told that they managed to sell. So we have two durations here actually. We have two. So we have period one. We have period one, right? So what you're going to indicate here will be for period one, Then what you're going to indicate this other side will be for which period? For period two. Will be for period two. Good. So let's see what we have. Under period one, when we are recording our sales, it will be what was sold, right? So period one, how many units were sold? They sold 60,000 units. So 60,000 units multiplied by selling price per unit given up here, multiplied by selling price per unit, which is 200, right? Will give us this particular amount. So we just need to put the comma style. Good. So I'm getting 12 million. I believe you are getting the same. I'm getting 12 million. Great. Then from the sales, we need to consider now cost of sales. Let's deal with period one, the whole of it. Now, under cost of sales, we need to consider opening stock. Do we have opening stock? This additional information is helping us to know whether there is opening stock or not. Number 6, there was no opening inventory at the beginning of the year. So we'll come here and talk about opening stock being equal to 0. To the opening stock, we need to add production. Right? So how many units were produced? Under period one, production is 75,000 units. Production is 75,000 units. Great. Now, this 75,000 units, what was the production cost per unit? Let's see if you're following. What was the production cost per unit? Under marginal costing system? What did we get as the production cost per unit? Somebody? Of course, we have it up here, right? We have it up here. Production cost per unit is equal to is equal to 120. So that's our production cost per unit. And of course, under absorption, that is the production cost per unit. Good. Have you been able to get the same answer? Have you been able to get the same answer? 9 million. To the production cost, we now need to less what we call closing stock. We need to less closing stock. All right. So if your opening stock in terms of quantity was 0, add what was produced, which is 75,000. It will give us total goods available for sale. That is 75,000. But what was sold is only 60,000. So what is the quantity of our closing stock? What is the quantity of our closing stock? Somebody? What is the quantity of our closing stock? Our closing stock is equal to, somebody, bring it down there. 15,000, right? So equal to 15 multiplied by the production cost per unit under marginal cost. We are talking about 120, right? So that will give us, and of course, remember, we are dealing with minus closing stock. Minus closing stock. Good. So what are you getting as the cost of sales? What are you getting as the cost of sales? So that you talk about gross profit. Actually, not just gross profit, but gross contribution. Gross contribution. So what are you getting? First of all, let's start with the cost of sales. What are you getting as the cost of sales? So our cost of sales will be equivalent to what we have here, right? That is what we have here. Our cost of sales. Our cost of sales is equal to 7,200,000, right? So 7,200,000, of course, we are going to deduct from sales to give us gross contribution. So our gross contribution is equal to this minus this one here, which is giving us 4,800 or 4,800,000. Then to that, we need to less variable. We need to less variable selling overheads. Variable selling overheads. Variable selling overheads. Variable selling overheads. Right? So variable selling overheads, do we have any? Yes. Variable selling overhead is equal to 10 shillings per unit. Now I have the 10 shillings per unit. What I want you to help me identify is how many units am I going to multiply by this 10,000? Is it what was produced, the 60,000? Is the 75,000? Is it what was sold, the 60,000, right? Somebody to help us get that under period 1. What will I multiply this 10 by to be able to get variable overhead? What will I use to multiply the variable overheads? What will I use to multiply this variable overheads? Yes, somebody? Somebody, the variable overheads. I will be multiplying by the unit sold, right? So the unit sold is equal to 60,000, right? So less variable overheads, That will now give me what we call net contribution. That will give us what we call net contribution. That will give us what we call net contribution. So to the net contribution, right? So that's our net. That's our net contribution. So our net contribution will be the summation of these two, right? Great. To the net contribution, we now need to less fixed cost. So what are some of the fixed costs that we have here? One of the fixed costs is the fixed production overhead. So we have fixed production overheads. The fixed production overheads. Do we have actual fixed production overhead within our question? The answer is no. So if you don't have that, this budgeted will be used. Our budgeted is 4,200,000 for the entire year. But because production is done twice in a year, we take half of this 4,200,000. We divide by 2 to give us 2,100,000. Then to that, we also need to consider what we call fixed selling and administrative overheads, right? So we have fixed selling and administrative overheads. Fixed selling and administrative overheads. What do we have? The fixed selling and administrative overheads are this amount, 2,800,000 for the entire year. For the entire year. So what do I need to do? I'll be taking 2,800,000, then I divide by 2. 2,800,000 divide by 2. So that will give me 1.4 million. So once you do that, we'll be able to get our net profit as per marginal costing. Net profit as per marginal costing is basically net contribution minus the fixed overhead. So that will give us net profit. That will give us net profit as per period 1. Great. Are we together up to that point? Are we together up to that point? Have you been able to get the same thing? Have you been able to get the same thing? Have you been able to get the same thing? Great. Good. So the next thing we need to do is to go to period 2. Let's move to period 2. So under period 2, we are talking about sales. How many units were sold? Period 2, sales for period 2, we have 70,000. 70,000 we multiply by selling price per unit, which is 200. So that will give us 14 million. That will give us 14. That will give us 14 million, right? Then to that, we need to look at the cost of sales. Do we have opening stock? Do we have opening stock? Yes, our opening stock is the closing stock for period 1. How about production? Production under marginal, of course, we know production cost per unit is this. Then we multiply, that is 120. We multiply by units produced under period 2. Production, 65,000 units. 65,000. There's a question here. Great. Oh, great. Good. Then how do we get closing stock? Do we have closing stock? So opening stock is 15,000. Production, 60,000, right? 60,000. So that will give us a total of 75,000 goods available for sale. Can we check what was sold? Did they sell everything or there's some closing stock? So if I go to period 2, they have, 65 is what was produced. 65 is what was produced. 65 is what was produced. Good. So 65 plus 15 will give us 80,000 units, right? Now, 80,000 units. Look at what was sold. They only sold 70. Are we able to identify the remaining closing stock? Are we able to identify the closing stock? Are we able to identify the closing stock? Good. So they produced 65 for period 2. They produced 65. Then our closing stock is 10,000. So we are going to replace 10,000 multiply by the value, the production cost. It will give us closing stock. Then how do we get gross contribution? Our gross contribution, number one, we have to bring all these costs together. We have to bring all these costs together and of course put it in negative form. Then to that, we need to get the summation of revenue and deducted cost of sales to give us gross contribution. To the gross contribution, we need to consider variable selling overheads. The variable selling overheads, you are told, is equal to 10 shillings. We multiply 10 shillings, we multiply by what was sold. How many units were sold? 70,000. So that will give us 700,000. Good. How do we get net contribution? Net contribution is there. So let's say, for example, in this case, sorry for that. We should have it here. On 20th of October 2025. We should have it here. Our net contribution is basically the summation of gross contribution, right? Is this gross contribution minus variable to give us net contribution. To the net contribution, we less production cost. So the fixed production overheads and these ones here, remember, they were constant. So what I need to do is to just have these figures being the same, right? So they were constant. That is 4,200,000 divided by 2, right? 4,200,000 divided by 2. The other one, that is 2,800,000 divided by 2, right? So that will give us a net profit of how much? I get the summation of these two. That is 1,400,000. Are we getting the same thing? Are we getting the same thing? Are you arriving at the same thing from your side? From your side, are you getting the same thing? Are you getting the same thing? Are you getting the same thing from your side? So that is what. Let's see before we proceed. Are we getting following keenly? Great, that's nice, John. Are we getting the same thing? Are we getting the same thing? Somebody to confirm, someone else to confirm. Great. So having done that, we now need to go to method number 2, that is absorption costing. So under absorption costing, we are going to interfere with the format slightly. So I just need to do this, just need to have that somewhere here for reference purposes. I just need to have it somewhere here. Then I will modify one or two things. So I'd say it under revenue, our revenue will not be affected. Our revenue will not be affected. So let's just interfere with what we have here. Let's interfere with what we have here. So under cost of sales, it will be opening stock. Do we have opening stock? No. How about production? Production is equal to units that were produced in period 1. That is 75,000 units. Then we multiply by production cost per unit. Under absorption costing, production cost is 150. Right? Then to that we less closing stock. No opening stock, production 75, sales 60. So we have closing stock of how much? 15,000 units. Then we multiply by the production cost per unit, which is 150, right? So that will give us closing stock. To the closing stock, we'll be getting what we call cost of sales. We'll be getting what we call cost of sales. So these are cost of sales. Now, what we're getting here, we don't call it gross contribution, but we call it an adjusted profit. Unadjusted profit, right? So this unadjusted profit will give us, or that will give us unadjusted profit, Remember, before when you bring this other part down here, this unadjusted profit, we must adjust it by looking at the budgeted or actual fixed production overheads. Then we compare it with production or fixed production fixed production overheads absorbed. Fixed production overheads absorbed. So the budgeted fixed production overhead, of course, we add it up here. Our fixed production overheads, the budgeted amount is 2,100,000. Right? Good. So this one here, we compare it with the fixed production overheads absorbed. Now, what was the absorption rate? We said, how did we get the fixed production overheads? We took 4,200,000 for the entire year, divided by the budgeted quantity at full capacity. It gave us what we call fixed production overhead per unit. So it means our fixed production overheads absorbed is equal to absorption rate, which is 30 per unit. This 30 per unit, we multiply by actual production under period 1. How many units were actually produced under period 1? 75,000 units. Right? So this is the fixed overheads absorbed. Now my question is, I want us to get what we call over stroke under absorption. Over or under absorption. If the real expense is 2,100 and what you've actually recorded as an expense is 2,250, what has happened? Have you over-absorbed or under-absorbed? Please help me get that. What you have incurred or recorded in the income statement is 2,250, but the real expense is 2,100. So what has happened? You have exaggerated your expenses. When you exaggerate expense, what happens? When you exaggerate expense, then it means you have understated your profit. So this is not the real profit. This profit has been understated due to over absorption of the overhead. So how do I rectify this? I add back the over absorption. I add back the over absorption. So I'll be adding back this 150,000. So we're talking about over absorption. Over absorption. So this over absorption is normally added. Over absorption is normally added so that we get what we call adjusted profit. So that we get what we call adjusted profit. So how do we get the adjusted profit? We take an adjusted profit plus over absorption to give us adjusted profit. To the adjusted profit, we now bring in the variable selling overheads. We now bring in the fixed selling and administrative overhead. So somebody is having a question. Why are you now exempting the fixed production overheads? Remember, under absorption costing method, the fixed production overheads are forming part of the product cost. So we cannot record them again under operating expenses here. No. Right? Good. The variable selling overheads will be the same thing because remember, these variable overheads are incurred when goods have been sold, the variable selling overheads. So how many units were sold? We have 10 units or 10 shillings multiplied by 60,000, which was sold. So that will give us 600,000. The fixed selling and administrative overheads will still be the same thing. What we add here, divide by 2 for the entire year. So that is 1,400,000. That is 1,400,000. It will give us net profit. So what is our net profit? As per absorption costing, it is adjusted profit minus all these expenses. So our net profit is 1,150,000. That is our net profit as per what we call absorption income statement in brackets absorption costing as per absorption costing, right? As per absorption costing. Let's move to period 2 under the same method. So period 2, we now have our opening stock. Your opening stock is very simple, is equal to this closing stock. Then I come and add production. How many units were produced during the year? The production cost is 150. We multiply by what was produced under period 2. So period 2 production is 65,000. 65 plus the closing of 15 will give us 80. Minus what was sold, we are having closing of how many units? 10,000, right? So that will give us what we call less closing stock. Less closing stock of 150 times 15, times 10,000, times 10,000, right? It will give us closing stock. To this closing stock, we need to get cost of sales. We need to get cost of sales. So our cost of sales is basically opening, add production, less closing stock. Then to that, we deduct it from the sales figure to give us what we call an adjusted profit. This unadjusted profit, we need to adjust it. We need to look at budgeted stroke actual fixed production overheads. Our budgeted or actual fixed production overheads is 2,100,000. Now that we are not given actual, we take the budgeted. Then we compare with the fixed production overheads absorbed. The fixed production overheads absorbed is the fixed production overhead per unit, which is 30. We multiply by units produced. Units produced is equal to 65,000. Is equal to 65,000. So that will give us what we call, the fixed production overheads absorbed. Now let's look at it. The real expense is supposed to be 1950, but what was absorbed, the real expense is 2100, but what was absorbed is 1950. So they understated the expense, right? So you can talk about over stroke under absorption. So this second one, we are talking about under absorption. They understated their profit. When you understate profit, you will exaggerate. When you understate this expense, you will understate or overstate your profit. So this profit is exaggerated by the same amount. So I need to come here and deduct the exaggeration. I need to come here and deduct the exaggeration. Which is 150,000. So that will give me adjusted profit. To the adjusted profit, I now need to look at selling overheads. The selling overheads is equal to 10 shillings per unit multiplied by what was sold. How many units were sold in period 2? 70,000. Then the selling and administrative overheads, of course, we have to divide it equally. 2,800,000. We divide by 2. We divide by 2. Right? We divide by 2. So that will give us 1,400,000. So once we adjust this, we'll be able to get, so adjusted profit minus these expenses, it will give us net profit as per absorption costing for period 2. It will give us net profit as per absorption costing for period 2. For period 2. Great. Now, before we proceed, is there someone who is willing to understand how to prepare a reconciliation statement of the same? Is there someone who is ready for the reconciliation statement? Is there someone who is ready for the reconciliation statement? Is there someone who is waiting for the reconciliation statement? Of course, we have to understand this part before we move to the reconciliation statement. Good. So are we okay with the first part? Are we okay with the first part? Great. So let's move to the next part. The next part is preparing a reconciliation statement. So this reconciliation statement will be having period 1 and period 2. Period 1, right? Then of course we have period 2. Now, what you're going to do under this reconciliation statement, is we look at one, our net profit as per marginal costing. Net profit as per marginal costing. So under period 1, net profit as per marginal costing is 700,000. Period 2, net profit as per marginal costing is 1,400,000. Good. Now, these profits will be affected by over or under statement of what we call opening stock and closing stock. So we have understatement, right? So we have understatement of opening. Then we also talk about understatement of closing stock. These two affected our profit. Right? So what do we do to the understatement of opening stock? Remember, opening stock is normally increasing cost of sales. And when cost of sales is increased, our profit will be reduced. Now, when you understate opening stock, you exaggerated your profit, right? You exaggerated your profit because yes, you exaggerated your profit. So we're going to do what? We are going to deduct. So we need to do what? We need to less understatement of opening stock. And of course, we need to add understatement of closing stock, right? Good, so let's see. So our opening stock in period 1 was 0. Our closing stock in period 1 was equivalent to how many units? 15,000 units. These 15,000 units were understated. These 15,000 units were understated by the amount of what we call fixed production overheads per unit. So the 15,000 units were understated because under marginal, we have 120. Under absorption, we have 150. So this 30, the fixed production overhead per unit, represents the understatement. So that is 30. That is 30. So it will give us 450, right? Good. So when we now get the total, it should give us net profit as per absorption costing. Absorption, it should give us net profit as per absorption costing. Is that the case? Let's see. If you add everything within that column, we are getting this amount. Is it equal to net profit as per absorption? Confirm if you're getting the same thing. Is it equal to net profit as per absorption costing? Yes. So that's how you come up with the reconciliation statement. Let's go to period 2. Under period 2, we have opening stock, right? So period 2, our opening stock is here. In terms of quantity, we have opening stock of 15,000 units. The 15,000 units we multiply by the understatement or fixed overhead per unit. What have we said? We need to less the opening stock, the understated opening stock. Then we add understatement of closing stock. So under period 2, our closing stock was 10,000 units. We multiply by the understatement of 30 shillings per unit, or the fixed production overhead per unit, right? So when you do that, we are getting 300,000. Once that is done, we need to get the summation to give us net profit as per absorption costing. So go to your absorption costing method under period 2. Are you getting the same net profit as per your reconciliation statement? Are you getting the same net profit as per your reconciliation statement? Are you getting the same profit as per the reconciliation statement? Are you getting the same profit as per your reconciliation statement? The answer is yes. So that is what you are normally required to do when dealing with marginal and absorption costing method. And of course, that is the procedure of coming up with a reconciliation statement. Why do we have the differences, right? Why do we have the differences? So that's how you deal with it. So remember, this concept is covered under 3 groups, or by 3 groups. So the first group to interact with this concept should be, those who are taking ATD, that is Fundamentals of Management Accounting. Those who are taking CPA Intermediate Level, that is Management Accounting, under topic number 7. And of course, those who are taking Advanced Management Accounting under price or pricing decisions. So under pricing decisions, this is one of the methods in which a company comes up with a pricing method, right? Good. So we are able to see that this concept applies to 3 groups. This method applies to 3 groups. Now, before we end our session, and of course, avail this particular video in our YouTube and even in LMS for those who have subscribed for the classes. Have you been able to learn something? Have you been able to learn something? Are you better than the way you joined this session? Are you better than the way you joined this session? Are you better than the way you joined this particular session? Great. So you look at the advantage that those who have already paid for the classes will be having. Number 1, they'll be able to access what we have done today in LMS without making any additional payment, right? Number 2, they'll be able to get notes for the same concept in LMS, right? Yeah, and of course, to get also video under the same topic for per semester for reference purposes. So as they wait for the teacher to get to that topic, they already have access to the notes and even materials for this topic. To be specific, topic number 7. Right, good. So those who have not joined and they have interest of actually enjoying those benefits that I've just mentioned, what should they do? How much should they pay? So if you want to do this course for the first time, CPA, ATD, CFA, or even CAMS, then you'll be charged 4,800 per unit. So if you want to join management accounting, you will be charged 4,800. If you want to join company law, financial reporting, financial management, you'll be charged 4,800. If you want to join the practical paper, that is business data analytics and financial modeling and data analytics for safer students, you'll be charged 9,000. Now, somebody's having a question. What if I want to retake this unit and I've never studied at RCM? Then, of course, you'll be charged 4,000 per unit, not the 4,800. What if I was at RCM and I want to retake the same unit? Then, of course, you get additional discount. Instead of 4,800, you now pay 3,800, right? Good. So what are the payment procedures or details? just go to your pay bill. This is the pay bill number. Our account number, you indicate the unit. So if you want to take management accounting, you indicate MA. If you want to sit for financial reporting, you indicate FR. What if I want to pay for 3 classes at the same time? So you just write your FR, your MA, your company law, right? Then automatically you will be able to make the payment for the classes. About advanced level, indicate the unit if it is AMA, AFR, right? And of course, triple A. So that's how you indicate the account name. Then you do your payment. For any inquiry after this particular session, in terms of maybe getting the fee structure, getting the timetable, please reach out to these 2 numbers. They'll be of great help to you. They'll assist you and give you guidance on how to access those documents. Of course, the most important thing you need to understand, you need to have access to the timetable and see whether your work schedule allows you to actually attend the classes. Now that we have the option for early morning and evening classes, that timetable will guide you so well, and you'll select the most convenient option for you. Great. Any question? Any question before we end our today's session? Any question before we end the session? Any question before we end the session? Great. So please make sure you join, because learning had begun, and of course your colleagues are actually learning. So those who are joining at this particular time, remember you'll be able to get access to what was done before you joined. Everything that has been done for the entire semester will be availed to you. So you will not miss something. But of course, it should not take much time to join, because April is approaching and you need to prepare adequately. So that is it. This session will be accessed from our YouTube 30 minutes from now. So ensure you follow it as you wait for the evening classes. So do your payment as early as now, so that you don't miss the evening. You don't miss the evening classes. So if you have maybe to look at the timetable, let me tell you what you should not miss. If you are at foundation level, then remember today on a Wednesday, you will be having a communication skills class at 6 p.m. and of course, economics class. So please do your payment not to miss the session. Those who are at intermediate level, for today, you have what Marginal from 6 p.m. You also have financial management at 8 p.m. Don't let yourself to miss today's classes. Those who are at advanced level, remember today you have advanced management accounting at 6 p.m. And of course you have AAA, that is advanced audit, at 8 p.m. Ensure you join those classes. And those who are now finalizing CPA, that is BDA, remember you have a class at 8 p.m. So do your payment as now, so that you don't miss the evening classes. Good. Thanks for your time and have a blessed afternoon. How do I join? Janet, just reach out to 0719 525 immediately after this class, and she'll be able to assist you. Reach out to 0719 525. The number is here, 0719 525. She'll be able to assist you immediately after this class, so that you don't miss the classes that I've just mentioned. See you tomorrow.